As expected, the Federal Reserve said it was keeping interest rates at 0 to 1/4%. That's where they've been for over 6 years. Now, this is great news for borrowers who are trying to whittle down outstanding credit card balances or small business owners who are attempting to close loans. But pity the poor saver who has struggled to eke out more than pennies on their hard-earned dollars. To help increase the amount of money you earn on your cash, try shopping around at credit unions or online financial institutions, which usually offer better deals. You may also want to consider purchasing longer-term CDs or bank-issued money market deposit accounts, both of which are insured by the FDIC up to the legal limit of $250,000. However, both of these carry penalties for withdrawing your money before the end of the term, or they may limit the number of transactions within a stated time period. Some brokerage firms have become more competitive in the CD market, but when you buy a CD from a broker, it usually has an additional risk. It can fluctuate in value. So if interest rates rise, you might receive less than you paid. Some people might not like that idea. Although inflation remains low right now, if you think that prices are likely to rise in the future, you may want to consider inflation-linked bonds as a place for safe money. I-bonds have two components: a fixed rate that remains the same throughout the life of the bond, and a variable inflation rate that is adjusted twice a year based on changes in the consumer price index. Now, one note here: if you cash in I-bonds before 5 years, you lose the last 3 months of interest. For more information about I-bonds, you can go to treasurydirect.gov. In New York, I'm Jill Schlesinger.